Welcome back, everyone, to Schwab Coaching for our next and final topic of the day, trading a smaller account. I am your host, Kevin Horner. Thank you all for joining me, though, here this morning. I'm happy to be here, still recuperating a little bit from an overdone amount of food yesterday, but nonetheless, happy to be here. Say hi to my friend Michael Fairborn there in the chat. Of course, he's going to be here to support me, answer questions that you all have that I'm unable to get to today, but I'll certainly keep an eye on things in that chat. Nonetheless, I do want to get to your specific questions as we work through the discussion here today. So take a moment and help us out. If you're not already doing so, follow Michael and me on X. I'm at Kevin Horner CS, and Mike, you can find at Mike Fairborn CS. Follow us there. We try to post for you periodically throughout the week. It's been a little quiet week for me on the X side of things, but not to fear. I'll be getting back at it here starting probably next week with some charts that are popping up and things from a pattern standpoint that might look intriguing and things maybe to keep an eye on as well. Lots to go forward here as we head towards the end of the year. The last thing I'll ask is if you like today's content, make sure you hit that thumbs up button for us down below. It helps us out on the archives in particular. And this show will, of course, be archived for you. So probably find its way to the archival on the YouTube page there by the end of the day, if not first thing on Monday. So with that, let's get started by working through some of the disclosure details, and then we're going to jump into a look at the overall market and, of course, some individual charts that might offer traders opportunity, but some key concepts that you want to keep in mind as it relates to working with a smaller balanced portfolio, or at least what we are defining for our class today as a smaller balance with which to work. So first of all, let's just remember that our discussion here is always informational and educational only. Simply, we do not make recommendations, do not endorse a particular strategy or trades for the market here. And absolutely, as it relates to the charts we're looking at, please continue to think of all of these charts merely as examples to illustrate our concepts today. We are not recommending these individual equities. Further, we talk technical analysis. Remember, this should be considered complementary in nature to your fundamental research. We want you to base decisions off a slew of details, not any one individual thought process. Of course, options carry a higher level of risk, are not available, or are not appropriate for all traders. They may be available to all of us individually, but you'll want to be familiar with the characteristics and risks of standardized options. We ask you to be approved on each account in which you would like to trade options, and you can have varying levels of option authority on those individual accounts. Just make sure you're going through the requisite steps to get approved in order to do that for you. And then the last note as it relates to options, you do need to be aware. We work in a paper money account here on the Thinkorswim desktop application. And in the instance that you trade short options in paper money, you will not be assigned early in the paper money account. However, this is a real factor that traders must consider. And when you're trading in a real account with real money in the live markets, you can be assigned on short options at any time. Now, the likelihood of that decreases with options that are out the money, but that does not guarantee you cannot be assigned. It does not guarantee that you could not be assigned early, that is to say, ahead of option expiration. So you do want to keep that in mind when trading short options specifically. Okay, in terms of an agenda, we're going to start off with a brief market overview. We'll look at the major indices here. We'll place a couple of new trades on the Thinkorswim Paper Money platform. I'm not sure if we're going to manage anything today, but we have that in the list as an opportunity for us. We'll see how wordy my explanations get for you here today. Remember, we go about 45 minutes in total. Again, I'm glad to have you all here. This will be the final class of the day and the week. So with that, let's talk a little bit about the concept for trading a smaller account. We are working forward with the belief that we're talking about a $20,000 portfolio. Now, a couple of key details that I want to give you here. We are not telling you that a $20,000 portfolio is a small balance. For many of us, that is a large balance with which to work. So let's just get that out of the way, okay? Now, what we do want to discuss and what we want to focus on when working with smaller accounts is at least, in fact, I believe we do this with large accounts too, we need to define our risk comfort. Now, for this class at Barb's discretion, we work through the $20,000 overall portfolio balance, max position size of $5,000, and then a max risk on a per trade basis of $500. Now, that might sound a little confusing if you're new to the process of proper risk management and building our trades through these concepts. So let's talk about this a little bit before we get into some of the nuts and bolts. The first idea is max position size should be flat dollars relative to your overall portfolio balance. And while we're working with $5,000 in a $20,000 account, that's a 25% position size relative to the balance. And not everyone is going to be comfortable with that. So in some cases, a trader might not have comfort beyond 10% to any one individual position, and that would be fine too. My encouragement is just to set these levels and then adhere to them as best you can. Further, if you've not done this before, if you are in the process of really getting your feet wet, understanding the actions in the part of trading that is most important, risk mitigation, then I believe it makes sense to start smaller and work your way up. Build those portfolio size positions to a much bigger level only as you feel comfortable. That's a good step. You're better off to start small and add risk rather than starting with a lot of risk and then trying to reduce it after the fact. So think about it like that. Come up with a percentage of your portfolio that you would be comfortable devoting to any one stock. We're going to work with $5,000 today. Now, the subsequent list, or the subsequent amount of risk, their max trade risk, is tied to the amount of money that you would lose if the trade goes against you. And in many cases, with options, for example, a trader would just invest the dollar amount on a long option position, whether that's long put, long call. The amount of dollars invested into that long option position becomes your maximum risk. When you trade long options, assuming you trade just the option and do not get assigned on any long option or exercise your long options, well, then your maximum risk really becomes the amount of money that you spent on the option itself. Of course, that changes if you do exercise your option and choose to buy stock or choose to sell stock. So you have to be aware that it won't always limit you to that. However, if you're trading exclusively the option itself with no intention of exercising your contract, then your max trade or max loss detail really does come out at the amount of money you've devoted to your option trade. Now, that on an equity side means that you're not spending only $500, but rather you're defining your entrance and your exit below if things were to move against you, and saying, all right, if I owned 100 shares of stock and I lost $5 a share, I would then move on from my trade. That would be approximately $500, right? So we're talking about assigning an exit strategy through the use commonly of a stop order, which would kick the trader out of the trade as the stock drops, goes lower, goes against the trader, and through a specified level that the trader says, yeah, at this price, I'm ready to move on. I no longer believe that I have the upside I thought I had originally. So let's look at this in action when we get to our individual equities. We're going to start, though, with a look at the S&P 500. There it is. And we're getting a little bit of a breakout here on this shortened market day, pushing to new all-time highs with our last trade, 6,042. Nothing negative about this. We can absolutely fall back on our friend's viewpoint here that new highs are generally not considered to be bearish. So we'll take this as a bullish view in the S&P 500, a little bit of a continuation move relative to where we've been, kind of reminiscent of what we had after moving to new highs back here. So you can see where we had, let me draw that as a line actually. We had needed to push through this ledge at around 5,700, which we did casually over the course of about 3 weeks here. And then we made another high and pulled back, made another high, consolidation in here, utilizing a short-term trend line, in this case, the moving average, the 20-day moving average, a big level that a lot of short-term traders will monitor in trend analysis. So we've got continuation working today. How high can this go? We don't know, obviously, but if we were thinking that the S&P 500 breaking out of the range that we've been in here, then a trader might look at this and just say, well, what was the range we just had? Well, whatever that range was, if this is a legitimate breakout, then we could, in theory, just add the height of that range to the breakout spot, and that might become our opportunity for the next profit-taking zone, right? So maybe that becomes your target as an estimation. That'd be about 6170 or so, 6165, 6170 as an approximation. Again, the reminder we offer when we start doing these measured moves and range breakouts and calculating expectation of potential upside, it's all a game of probabilities, never certainties, right? So while we might target 6170, believing it can get there, there's no guarantee that it will. So thereafter, how about a look at the NASDAQ? We've been in this nice upward channel, working aggressively, the slope of which is maybe getting a little uncomfortable for some. We did make that new high back here about a month ago, a little less than that, excuse me, more like 2 weeks ago. And we have managed to make higher lows along the way. So if you're a shorter term trend trader, you have not exactly been given reasons to be out of even the NASDAQ 100 here, everybody. Sure, the initial open back here in early August, August 5, after we had made this major pullback on the so-called carry trade here, if you'll notice, the pullback was big. Percentage-wise, came out to 15% on the NASDAQ 100. That certainly gets into the range where traders start to get a little bit excitable when you find a pullback as substantial as it is to an area of major support. In this case, the 200-day moving average right there, right? And put the oval right on it. That became an excellent entrance opportunity if you had the wherewithal to step in. Usually it's the couple of days following that traders start to gain that confidence. But I know how we do it, right? We traders up here, we say things like, man, if I could just get this thing to pull back 10%, I'd love to be a buyer. Or if it could see the 200-day, I'd love to be a buyer. And we all feel like that until that instance happens. And then we get here and it gets to be a little bit more difficult to put that money to work after seeing the group drop 15% so quickly. I know a lot of times traders will just take their opportunity with very small positions, limit their downside risk, be willing to be wrong, but be wrong small, right? Lots of little losses are okay. It's the big losses we try to work against. Okay, so there you go. We've got a nice upside with the S&P. We've got the NASDAQ challenging and looking to try and do the exact same thing that the S&P 500 has done. Let's talk about trades that can be made within a smaller account that might not be exactly in line with what a trader expects. So the very first thing that I want to remind you all is that trade per share, price per share can be difficult to work with, right? So if I was to pull up the Market Watch page and I'm looking through the NASDAQ 100, there are many positions in here that would seem untenable for a trader in a small account basis based on what we're talking about here, right? $20,000 account size, max position size, $5,000. That means we could maybe own a share of Booking, right? We could buy a share and maybe do okay. We could do a couple shares of Mercado Libre, or we might be able to get as many as 5 or 6 shares of Costco to stay within our amount that we want to devote to any one individual position, right? And some traders are going to be fine with that, and that's okay too, because I'll remind you, 10% profits, whether you have 1 share of stock or 10 shares of stock or 1,000 shares of stock, 10% is still 10% of whatever dollar you've devoted to your trade. And I want you to think about it like that, because the moment you start thinking that, well, I have 100 shares of this one and I have only 2 shares of this one, the moment you start looking at shares in lieu of dollars devoted to your position is the moment you put yourself in a bad spot. So be thoughtful about this. $5,000 max position size dollars devoted to your individual positions, not number of shares. Okay. So we can attack stocks that are still large in price and make them work within a smaller dollar account like this. And again, it's not likely to be through the use of underlying equity shares, just buying a couple here or there. It's much more likely to incorporate options. So let's take a look at, let's use Costco as an example. You know what? Let's use, let's look at the charts first. Let's see what we got. Let's put booking in here and let's just see how the put that in the wrong spot, everybody. We'll back that out. Here we go. All right, booking. Booking, trading at highs. Okay. Let's try and define the chart a little bit. What do we have? Well, it looks like we've got a nice uptrend. Boy, this is almost perfectly consistent with the lows in the NDX here, right? Right off the low at down here on August 5, a very weak open. That was below the 200-day moving average, and it's managed to push itself up. But we've been holding the 20-day for a lot of it. So you have a lovely uptrend working. We have a big gap move, followed by a little consolidation in here. Okay, and now we seem to be getting another bit of a flagpole, don't we? We've got a flag from here, like so. And so some traders might be thinking, well, we could maybe see a breakout through this 5,200 level. I'm going to have to resize my chart here. Check this out. I'm just going to go over to the price range, shrink this down through a click and drag function. And that allows me to take the line that I've made, my flagpole, and I'm going to try and do a measured move calculation just on the most recent short-term action here. So I'm going to take and activate that trend line 4, which was my pole, and I'm just going to add it to the top. And so this might give us, if we were thinking that we have this amount of upside and we believed in a breakout, or we are thinking a breakout's coming here, maybe we think it can get up to about 55.50 or so. That could be an opportunity, right? So how could we build a trade that would allow us to take advantage of upside opportunity here and do so with a limitation not to exceed $500? So let's jump over to the trade tab and let's go and peek at a couple of these periods here we've got to consider. So here we are with expiration today, the 29th. Let's give it about 3 weeks. Now, why 3 weeks? Well, the time frame that we're going to try and trade for here is going to be consistent with about the window of time we've been monitoring, or at least the most recent price action here, right? So we had this 2-week consolidation, a 1-week bull flag. If we think it's going to break to the upside, we could be early on this trade, right? Why? Well, because we've not really broken out. We don't have a close over the highs we've created yet. So we might feel better being patient here from a technical aspect. Trader might be better suited just to be patient, let this break out, and then put on the option trade. That might be a more comfortable approach for many of you. I just want to point out, we've not broken out, but we're going to build this on the belief that a breakout could be coming, okay? So 5,200 is our current ledge. And one way that a trader is going to think about this is to consider giving the stock a bit of an opportunity, but buying a long call. In this case, we're going to discuss a call vertical, buying a long series of strikes and pushing it out a little higher in the hopes of it continuing to make its move upward. And we could easily, if it goes in our favor, pull the profits from the trade rather quickly if it goes our direction. Now, the key here is that if you're buying on the call side, we want to get as much movement close to dollar for dollar as some traders want. They want to buy a higher delta position. They want to profit more by movement in the underlying stock. Now, the challenge we're going to have here is absolutely noting the spreads. Look at the size of these spreads, everybody. This is tricky, right? And we're not really looking at a lot of volume in these contracts. So, the more I look at this, the more I come to the belief that maybe this is more difficult than we need it to be. Couple of points. Number one, if you're a buyer of the contract here at 52.10, look at the spread. 20 points. That's $2,000 in this contract spread. So while we could make it work, that doesn't necessarily mean it makes sense. We could absolutely put this together, but if you start to think about it and say, well, what's the midpoint on this? I'd have to be buyer at about 114, and I'd have to do a whole bunch of math. Not every trade is going to set up beautifully. And my encouragement is to look at this and go, boy, I am really making this more difficult than I need to. Lack of volume, which means lack of liquidity with big wide spreads. This might not make any sense. And guess what? That's okay. It is okay to step away. Great point, Paul. Where would we find maybe more activity? Well, weeklies on something like this might not be the best spot. Just quickly noting how few contracts have open interest and how few contracts have traded. We'll double check. Let's go to the monthly contract here. That's the December 20. And there's much more volume, as you can see. Open interest is also notable here. This makes it a little bit more tenable, doesn't it? And yes, we still have wide spreads, but we could make that perhaps work. And now you might be more confident simply because there's enough open interest out there and enough volume to maybe say, yeah, I can make that fly. This might actually be okay if you were looking at something like the 5200s, for example, and you thought you could sell, I don't know, what about the 5250 here? Now, the problem there, as you can see, still running into a cost situation, right? $2,500 devoted to the trade, that's a lot more than what many of you would be thinking about. And it certainly doesn't fit for our risk tolerance here on the per trade basis. If we were to try and do something like this, everybody, it looks like we would have to, we would have to do it as maybe a $5 spread, or let's try a 10. What if we did the 5200s and the 5210s? Yeah, we would actually be able to do about a 10-point spread and stay pretty close to our comfort zone. Okay. Now, we're not going to do that here. I wanted to walk us through and discuss what a trader might conceive of by looking just at the strikes and assessing volume and open interest along with your spread detail to maybe recognize that this is not going to be ideal for all traders. Now, we could make it work, but that doesn't mean we want to. So I wanted to have that discussion. I want to move on from it. But I hope that at least kind of opens our eyes to the reminder that not every trade is ideal, right? And it's perfectly fine. Even though you feel like this might set up beautifully, it's okay to walk away and say, it's just not quite right. All right. Let's go back to that market watch real quick. Let's grab Netflix here. All right. So here we've got Netflix. We're going to find Netflix because of its activity level. I'm going to guess we're going to find this to be a little bit tighter in terms of spreads between the bid and the offer. I think that's going to be helpful. So let's go to the trade tab here. Before we get there, let's just look at what we've had. Consolidation, rally, bull flag setup. How high could this one go, everybody? Well, we may be in the midst of breaking out, right? If we were just going to use the bull flag calculation here, let's just take that flagpole height and let's just add that to the potential breakout. And again, some of you may want to go here, right? Some of you might want to go down here. We want to draw it from the bottom of the flag to limit your upside and therefore give you an earlier exit strategy. Others might want to add it to the breakout spot to get a higher level. Okay, that's also fine. All right. So we're looking at possibly pushing up through 890 to 900 and maybe getting up to 990 up to 1,000. So let's see about putting together spread detail here. And I'm glad I got this question, everybody, about how did we get those trades to line up together? It's all about utilizing the control button on your laptop here. So, for example, if I wanted to consider buying the 875, I might hit the left click on the ask, and then while pressing and holding my control button, I could go to the 885 contract, hit the bid, and now it stacks them, right? So now I've got a stacked order, 875 by 885, cost 575, a little bit beyond our comfort, and nonetheless could still make that work, right? And then let's just remind ourselves what maximum gain might look like here, everybody. Remember, you can always do the back of the napkin math on that and just say, all right, what is the spread? 10 points. What is the cost? 580. The net profit is the difference between your spread amount and your net cost. So our walk away, if it went to fruition, which would have us closing above 885 on December expiration, we could walk away making $420. And if we got in at 570, 430 approximately, short of any fees, of course, right? So that can still work yet again, even in an account where you're trying to limit your costs and your downside risk. Now, this is another one where your delta might not be high enough. A lot of traders love the idea of a higher delta because it gives you greater dollar for dollar movement in the option contract relative to the dollar movement in the underlying equity. So a ratio right here of 56 means one of two things, or traders think of it in a couple of different ways. 56 cents move for every $1 move in the underlying stock, or some traders think of it as the percentage likelihood that a given contract is in the money at expiration. Okay, so those two concepts as it relates to delta. And again, some traders want to get more bang for their buck, and that's where they are willing to go deeper in cost, right? Deeper in higher delta, deeper cost, deeper in the money relative to where we are trading at any given moment. So in order for this one to work for us, in the sense that we want to stay under our $5 limitation, we are going to need to make an adjustment to our entrance. So we have to go higher in the contracts. We can't be as in the money because that's going to increase our delta. It's going to increase our cost. So if we went to the 880 and sold, for example, the 890 for our 10 spread, it drops to 530. If we went up to 885 for our entrance, which is still in the money, but not by much, and went to 895, so we're still looking to make 10, but now we're under our max cost. Okay, so here, this is basically a risk a dollar to make a dollar trade, right? So in this scenario, we would be in our comfort zone for $500 maximum, but we are buying a contract that is just less in the money than the deeper in the money contract. And so we have more risk of this particular contract finishing out of the money than we do this one, right? So it's always a balancing act as traders. We have to think about those things and start to maybe stack the pros versus the cons. Some of you will agree with Grant that it's not worth the risk. Some of you would say, but that's exactly the level I'm comfortable with, and I would go with it. But that's why we're all talking about it, because the conversation differs from trader to trader, right? And a spread like this, yeah, I mean, look, if the stock has to close over 895 on expiration Friday for us to take away our maximum gain, but that does not mean we have to hold it to the December 20 deadline, do we? In fact, many of you set those levels and say, you know what? If I pull this up any given morning and I find that I'm up, I'm not quite at $500, I've got only 350 of my max $500 profit. That's enough for me today. Or I don't like what I see out of the market, I'm going to go ahead and cover that trade. I'm going to take my 60% profit relative to what I thought I was going to get. That's fine too. All right. So let's put this one on just so we've got a trade to monitor. And then we're going to go utilize the scan tab and work to find a trade that's not option but equity relevant. And we're going to do that next. So here we're going to buy one vertical December 20 contracts, incorporating an 885 call with long and then a short 895 call. So we are stepping in to a $10 spread. Our cost is going to be $5.18 at this point. Max dollar gain 482. Again, that happens on expiration Friday if the stock is above 895. So hit send on that. And we've got a limit in, and there we've got our fill. So I'm just going to jump back over to my monitor page, and I'm just going to move this into my trading a smaller account group, which will make it easier for me to see next time. There we go. All right, let's jump over to the scan tool, everybody. I built a scan pre-show to locate stocks that might be a good approach. Let me share this with you all. What I've done, and I say might be a good approach, it might be a good approach for a trader who wants to work with equities and wants to stay within a reasonable amount. So what I've done is just build a scan within the S&P 500 for stocks between 10 and 50 a share, of which there are 67 total. But I've added some custom criteria in here. So let's look at that. The custom criteria that I've added is a volume average, 500,000 shares. So this is to ensure that we have enough liquidity to enter and exit our trades. I also want to be finding bullish scenarios. So in this case, I'm looking for stocks that are greater than their 20-day moving average, greater than their 50-day moving average, and greater than their 200-day moving average. I have incorporated these as simple moving averages. Feel free to make adjustments, play with it, etc. But let me share this with you all, and you can utilize this. Why do I go with the 20, the 50, the 200? Why do we want to see that the stocks are all above those three moving averages? Well, if you have a stock trading above all three of those moving averages, it means that it is uptrending in three different time frames. And that also means that we have three different types of traders monitoring these positions, potentially giving us maybe additional upside lift, possibly. So let's take this, share this scan. All right. So we're just going to I'm going to give it a name for you all here. We're going to say bullish above all SMAs, although we know those are not all SMAs, just the notable ones for our example here today. So I'll share this with you, and I'll just remind you that our scripts like this, these are not guaranteed for accuracy. They are not guaranteed for timing, and they are not a recommendation for their use. Hopefully, however, you can find this to be helpful. And further, my encouragement would be to play with it a little bit, play with some of these customizations that you have available, and get a little more comfortable utilizing that scan tool. Okay, so what do we have? There's a list of 37 stocks that I have created custom screen here, or custom columns. Don't forget, you can use the gear and play with your columns here. So any other detail you want to add in, make sure you do that. I've got it sorted by low price. Some of the lowest dollar stocks in here, Warner Brothers Discovery. If I want to flip that and show my highest dollar stocks, I've got Corning. Let's take a look at Corning GLW first. So we've got an uptrend here working. Some traders would say that they like to buy stocks in uptrend, but they might very well like to do so nearer a position of support. And I think if you looked at this one, many would suggest that good support here could be found at the 50-day, but you also might have to consider this horizontal zone of support with this last low from the 19th. That low came in around 45.80 or so. So maybe perhaps they'd be comfortable with an exit strategy under 45.80, but that does mean they're risking about $3 a share. So you'd have to consider that. All right. So there's one you might give some consideration to. I always like to look at a few charts because I want to be wowed. I want my initial reaction to these charts to speak to me a little bit, right? I don't want to spend minutes looking at the chart to make the chart make sense or to create a trade that'll fit. I want the chart to speak to me immediately, and I want to say, now is the time. And that's when I'm going to step in. That's generally what I'm looking for. I need that that involuntary reaction that comes from just looking at as many charts as possible. So let's keep on working. What else? Fox A. Let's see. Now see, that's a little bit intriguing here, everybody. Why? Well, we broke out from a nice lengthy base here. This looks like about a month long, 34 bars. Yep. So that was actually about 6 weeks in length here. And wow, love this from a upside ascending triangle, broke, right? Had a bull flag right here that was resolved very quickly. And now we're in a bit more, let's back and fill this. Let's consolidate. Let's see if we can't get that 20-day moving average to get caught up. This looks a little bit intriguing. Let's back this out to a lengthy weekly chart. Let's, in fact, add a little more time because I want to make absolutely certain that I'm not finding resistance. Aha, very important. So what have we learned is we have highs back here. So this becomes a potential target for some traders. Of course, we know targets don't have to be achieved. But when we zoom in, it also seems notable that we took out what was major resistance in here. Look at the tails that we got right through here. Tails in this zone, right? I'll highlight them here for you. There, whoops, that was supposed to be an oval. Okay, let's try that again. So there we go. There's another tail. We have worked through those very cleanly now, right? So even a longer run trader is going to look through this band of former resistance and say, now that's potentially support. And look where that resides for us here, below a 20-day moving average. A trader could build a trade right now working against the 20-day moving average and be within reason for their tolerance for risk. So let's do so. Let's look at that. The 20-day is 45.62. We are at 47.35. So we'd be risking about $1.70 approximately. That's reasonable. What's our upside? Well, if we were taking our upside as just the move we've made from 42.75 to the peak we just created, and we think that a breakout were coming, well, then maybe we can make that move, right? The height of our pop to the upside. Maybe we could do that. So that would be about 2.3%, it says, right? So if we added this, where does that go? Add it to the, oh, well, that's kind of cool. It goes right to 52. So that seems notable. And that happens to be the prior highs, right? So all of this approximation math stands out a little bit, doesn't it? So this may work for an equity trader. Now let's build that trade with the target zone of our downside risk tolerance. So we've got only about 7 minutes. So admittedly, we're going to talk about this a little bit quick. And I'll apologize in advance, but this is going to be archived. You'll be able to come back into the chat, back into the YouTube coaching page and find it in the archive. Spend your time. Okay. So here's what we're going to do. We're going to talk about the 20-day as our exit strategy, but we are going to incorporate average true range below that so that we can maintain our position possibly a little longer. We don't want to get taken out on intraday fluctuation below the 20-day. We want to be taken out if the trend breaks. So first thing we will do, the 20-day is 45.62. I'm going to add an ATR, and I see that the ATR is 91 cents. So if I wanted to be conservative, I would maybe increase that to $1 and then go $1 below 45.62. And I would say, all right, 44.60 it is. And what I like about that in relation to what we're seeing here is that this low on this day was 45.78. That means you would have to trade below this low to be stopped out if I put it in at 44.60. Okay. Now that does not guarantee that I won't be stopped out anyway. I can absolutely be stopped out. That's okay. But that's what we're working to do, is try and keep the position as long as possible. So if we are putting a stop at 44.60 and our current price is 47.33, well, we've got a little bit of risk here, right? So we are looking at $2.70 of risk. So that tells me we can't really own as many shares as we might like. We can own 100, right? And that might be the maximum because we don't want to exceed our 5,000 share position size, which I managed to erase. So I'll just remind us. So here's some options for you to consider. You can just say, well, 100 shares would be 47.34. That's less than 5,000. I'm comfortable with that. Or we could just do the absolute math on this and take it to the maximum. And we use the calculator and we take our $5,000 and divide it by the price per share. 47.33. So we can own 105. All right. So we round down, right? 105 shares. So let's go with that. We'll buy 105. We'll put our stop at 44.60. And hopefully we'll be able to ride this for a little bit. Okay. Now, risk versus reward. Admittedly, if we get to 52, our upside's about $4.70. And then our risk, as we noted, is about $2.70. So we're close to a $1 of risk to $2 of opportunity. That might be enough for many of you. And some of you would say, yeah, Kev, you've talked to me enough about 1 to 3 risk to reward. I'm going to be patient and I'll let this one go for now. Maybe if I could be a buyer nearer the 20-day, so I'm massaging my risk tolerance a little bit, those traders might feel more comfortable. And I would understand that. Again, I'll reiterate, what matters is your comfort with your process. Build your process and then stick to the process. Or as many of us coaches say, we plan our trade and then we trade our plan. Okay. So let's build this out with a right click in here. I'm going to do buy custom and I'm going to do it with a stop. I am not going to put a target. You know what? That's silly. Let's do a target. Let's do both with an OCO bracket. So that means one cancels the other. We will buy right away with a market order, which guarantees no price, right? I'm just going to take the next available price. I'm going to buy 105 shares, the maximum. And I want to make sure that my exit strategies below also come to 105 shares. So I'm going to hit that little red icon here, which is going to link up my exit orders as soon as I tab off of my buy. Here we go. Oh, that's not what I wanted. I've got too many. See, got to double check. There we go. 105, everybody. So we're going to buy 105 at market. We are going to set a limit target to sell all of them at 52.20. Hopefully it gets there. Why did that not take? Here, try that one more time. 52.20. And let me just give you all visual on that. There we go. Limit at 52.20. Good till canceled. Good till canceled on my stop order. And we said that was going to be 44.60. So I'm just going to make that 44.60. There we go. Now, the reminder about that stop order, everybody, we have gap risk. So even though we want to execute at 44.60, that's our trigger. And if we trigger at 44.60, we're likely to get execution pretty close to 44.60. However, let's say we closed today at 47, but Monday we opened at 40. Well, that open trade is the first trade below our trigger price. We trigger at 40, and then we have a market order to sell. We're going to execute pretty close to 40, aren't we? It's not likely to be close to our stop price, okay? So you have to have that in mind. There is no guarantee of your exit price with a traditional stop. Yes, you can get an execution guarantee on price, but if you add in the limit, there's no guarantee of execution, right? Yeah, you can get your price, but you might not actually get that price. You might not even be sold out, okay? So the stop limit could be better for some, not for all. All right, so let's go ahead and hit confirm and send. Buying 105 of Fox. Market, subsequent limit at 52.20, subsequent stop at 44.60. Only one of those two orders can execute. All right, and there we go. And now you can see that I've got it on the chart. They are linked together on the chart as evidenced by my little chain link right here. I've got the exit here and the exit here ready to go. So we are locked in, everybody. We can just sit on our hands and let the market do what it's going to do. One of those two trades is liable to execute over the next 179 calendar days. With that, we're at time. I want to thank you all for being here. I know we covered quite a bit, but the big reminder that I'm going to leave you with is the one I stated just a couple minutes ago. Plan your trade and trade your plan. It's the adherence to the rules that you've determined to be important for your trading that are going to set you free in trading the market. It requires discipline and a process. Make sure you're doing that, everybody. Okay. That's the one thing I can tell you. I can't give you specifics, but I can tell you that if you plan everything out and you stick to your rules, you're going to be very pleased with the way that makes you feel along the way. Okay. All right. Big thanks to Michael Fairborn in chat. That is a wrap for the week, BJ. You're absolutely right. Thanks to everybody for being here today. Thank you all for being here this week. I hope you all have a fantastic weekend. We will reconvene on Monday. I will kick things off with you all for Trader Talk at Market Open, 9:30 a.m. Monday morning. Have a great weekend, everybody.